Welcome to our monthly talk on the world economy. Recent interventions have led some people to speak about currency wars. What does this mean for currencies, for the global economy, and for the stock markets? With us today is Giles Keating, head of the Credit Suisse Global Economics and Strategy Group. Giles, in layman words, what exactly is going on in the currency markets?
Well, really two big things. On the one hand, in the United States, the Federal Reserve has signalled very clearly that it's moving to quantitative easing, which means buying bonds to try to keep interest rates low and indeed indirectly even stimulate the stock market. That, of course, means a greater supply of dollars into the system. That's tending to weaken the dollar. And then the second thing that's going on is that a number of countries are trying to resist the scale and the speed of that dollar weakening. They are moving out there, and we're seeing some intervention, and we're also seeing some taxes on capital inflows.
Now, officially, the global recession is over and things are starting to pick up again. Why would economies aim at keeping their currencies weak?
I think it's all a matter of the speed and the scale of movement. So I think a modest and progressive move, many, if not most countries, particularly emerging ones which are growing rapidly and have a potential risk from inflation and which perhaps want to become less reliant on exports. So they don't mind some appreciation, but as it gets too far too fast, then they fear it could actually damage their export industries and become destabilizing. So I think a modest move, yes, that's consistent with an improving global economy, but too rapid a move, that does cause problems.
Can you give us examples on which economies are profiting in this situation and which currencies are affected most?
What we've seen over the last month is virtually all major currencies moving up against the dollar. We saw the euro and the Swiss franc in Europe, the yen's been strong, and then in the emerging markets, most of the major currencies, including the Chinese renminbi and the Brazilian real and many others, have moved up. And I think it's been the pace of that, which although it's been obviously attractive for investors involved in those currencies, that is what has caused some concern among policymakers in those countries. They do feel that very rapid move up could damage their economies. So in just the last few days before we're doing this interview, we've seen the dollar actually regain a little bit of ground. I think that's probably a relief to everybody, even if the long-term trend in many of those currencies is up. The move we've just seen was a bit too fast.
There are discussions on whether monetary unions could be a solution to the problem, but the euro and the dollar have both proven that even monetary unions face serious challenges. Would a monetary union, let's say, for Asia, make sense?
I think a literal monetary union is not on the cards. There are far too many political and economic barriers to that. But what I think might be possible, and indeed clearly some world leaders are trying to look to this at the G20 meeting that's coming up in early November, is to look for some loose agreement which would probably involve an agreement that the United States would indeed be doing a degree of monetary stimulus, but would do that in a measured way so it didn't create too much short-term pressure. And meanwhile, from the point of view of the emerging currencies, they would be looking to a gradual move up over not just months, but perhaps a number of years in their currencies, which makes sense from an economic development point of view. It fits with the idea of rebalancing to less reliance on exports, more reliance on domestic demand, consumption growth in the emerging markets. So I think a kind of loose agreement of that type is possible, but it does require a real coordination effort among the international community.
Now, in this environment, where are the opportunities for investors and what must they bear in mind?
Well, interestingly, my colleagues on the Global Economics and Strategy Group and also on the Investment Committee do feel that this is rather a positive environment for stock markets, as well as for some further compression. It's gone a long way in some of the spreads in parts of the credit markets. And the feeling here is that the effect of the quantitative easing in the US really is designed to push up stock markets and credit markets. That's the way that process works, by making capital cheaper and by making those financial assets less attractive to people, so they want to go out and spend. So we think that investors should be riding that wave upwards. It won't be a straight line, of course. And meanwhile, there are potential opportunities in currencies. We've seen the dollar actually regain a little bit of ground recently. That could, for example, be an interesting entry opportunity into some currencies where the longer-term trend, particularly in the emerging markets, is still upwards.
Thank you, Giles. If you want to know more about what is going on in the global economy, visit our website creditsuisse.com/markets.